Welcome to episode 75 of UnCommonCents. Dean Holmes here with my special guest, Tim Lane, who has joined us for the second time. So welcome, Tim. It's not as many callbacks as you get from your music career, correct?
I don't get a lot of callbacks.
Fair enough. You'll hear a little bit more about Tim's other side hustle towards the end of the podcast, but he is a famous musician with a Spotify account, so we'll talk about that throughout the end. Tim, we're here to talk about structuring financial planning businesses and managing your ownership of financial planning businesses.
Yep.
Obviously, we know that saying of start with the end in mind, but sometimes it's not always possible when we're already in business. We started with zero money, and so we did it on the cheap, or we've managed to be within a business that already has a structure. So I'd love to firstly hear a little bit about you and your journey for the context for listeners, and then we'll dive into this conversation about structuring businesses, debt within business, and the eventual sale of businesses as well. So over to you, Tim.
Thanks, Dean. So I'm Tim Lane from FinConnect Advisory. Sorry, I should have the back of the screen. I'm a chartered accountant. I started working with valuation and succession issues for financial planning practices in 1999. So I've had a lot of time, done a lot of things. Probably that just tells you I've made a lot of mistakes that I've learned from over that journey. So that's how I get here. I'm a chartered accountant. The difference with me, I think, probably is that I own a practice. I own a practice that does financial planning, and I'm actually have been an active financial planner. So I sort of understand the day-to-day of what a financial planner does and how that would affect the valuation and all that sort of stuff. So essentially my role and my team, Fiona and Courtney, as well as just been problem solving around all these issues is what we do. But yeah, that's sort of me in a nutshell. And as you've rightly pointed out, when I'm not doing this, I attempt to be a musician in my other life, which we'll talk about later.
Amazing. So let's start at the beginning in this journey, Tim, of just what the structures that you see and then what the structures that you think is ideal. Obviously, we're not sole traders when it comes to financial planning, but we see trusts and companies and partnerships come up from time to time. So just tell us a little bit about your experience on if you're starting from scratch, where that would end up.
Yeah. So there's a sort of the tax issue and there's sort of the industry issue. So just to sort of pull that all together, what you'll find mostly now is you'll have to actually have a company to hold a car anyway. So to a degree, the advice is a bit mute around that, but and then people think you have to go straight to company. You can actually be a sole trader for a period of time and then flip to a company relatively easily. But I think we assume that everyone is in some sort of corporate structure. So my view is that the normal structure, and it isn't just financial planning practices, it's sort of everything, should be owned through a company where you can, and with that shareholding owned in a discretionary trust, and that trust has the ability to distribute to a lower shareholder. That's the common structure we use. There is a sort of hoopy sort of hybrid of that where you would own a client base in a unit trust with a license agreement. That's a complexity which you don't really only deal with based on some particular circumstances. I think the issue you get is that as a financial planner, you need a company for these sort of reasons. One is it has a longer term operational tax outcome, but also unless you're intending never to grow and never to bring a successor in, which is unlikely, a company's going to give you this ability to slice and dice your equity to other people. So that's the major issue. The other thing is, what we need to understand is that the cash doesn't always follow profits for various reasons, debt reduction, all these things. So a company provides a place where you can park profits predominantly at the 25 cents in the dollar area, and then have some visibility on what you do with that down the track. So that always leads to a company structure. Having said that, others will work, but somewhere in your structure, particularly so you've got to remember that financial planning practices, once they get to a certain size, are quite profitable. And so they're going to push out profits, and those profits aren't always going to be followed by cash as much as others. So you really need somewhere to park those profits and be able to time them out, and the company gives you that option. And then the other thing which people always forget is that if I'm not using a company structure and I pay tax, excuse my French, that tax is pissed up against the wall. It's gone.
Mm.
And a company can hold a franking credit and use that in the future. So that's one of the other advantages that people actually don't tend to understand. I was working with a client today, and basically the tax bill was about the same, but at the end of the day, one was the tax was gone, and one was we retained the tax to do something with the franking credit to do something within the future.
Something within the future.
So that was always the better outcome.
Absolutely. So Tim, that's the difference. If I make, really keeping it simple, I make $1 profit in a company, 25% tax we know is paid, but there's a franking credit there. Whereas if that was trading just in the discretionary trust, for example, that dollar has to get distributed to a human. And as financial planning businesses become more profitable, there's not as many humans on a tax rate less than 25 cents in the dollar. And once it's paid out in that ability, you can't get it back. So if you were trading in a trust and then you had a good year, for some reason, just one-off good year, that money still has to get paid out from a distribution perspective to beneficiaries. And then also, the other part that you mentioned is the money doesn't always follow the tax, in that we may need the money back in the financial planning business to either run the business first and foremost, or we might have to make pretty hefty debt repayments, which we'll get onto, which means the money has to sort of stay in the structure.
Correct. And it can easily be parked there at that better rate. And, goes, a lot of my larger clients, not all financial planning clients, but, what you're seeing is these entities also pass through to their estate now. And their estate has these franking credits and this future income to deal with that isn't otherwise going to be there. So that it's a very effective way to work.
Yep, perfect. And so talk to us about the end game, like this idea of the small business capital gains concessions and where that fits in. We don't always think about selling our business on the day that we start our business, but what are the considerations around thinking about these couple of rules and whether we should do things sooner rather than later in the journey to get ready? Yeah.
So you got to remember, there's really, when we're doing transactions or we're doing success, it's really only two transactions that occur. Ones are, I buy or I sell my shares to either, a big hairy monster like AZNGA, or I sell it to incoming successors. That's transaction one. And then transaction two is I sell my client base to someone else. And both of those are what we call capital gains. And both of those, generally speaking, will generate a large capital gain to deal with. And so the way the small business tax exemptions work, they're actually relatively simple. It's the qualification piece that really challenges people and you can get wrong. But let's just talk through the first example, which is I sell my shares. So capital gain is triggered. What happens is those shares will then be able to receive what we call the general discount. So the general discount is the 50% that everyone gets on any capital gain in the wide world in Australia. Get that. So $100, say, becomes $50. And then if you determine that asset is an active asset, and there's a set of rules around that, you can then apply another 25% discount. So what happens is that the $50 becomes $25 is accessible. And then, the next thing you can apply is what's called the retirement exemption. And in certain circumstances, after the age of 55, just the gain dissipates altogether. So that's the first set of circumstances where you would hit that. And again, if you've got a big company, you're bringing successors in there buying from you. If you get through the qualification rules, you can sort of mostly do that tax-free. There's some limits on that. Bearing in mind the retirement exemption has a $500 per person. So if you're a couple, that's $1 million. So you can get rid of some seriously big gains quite easily.
Because it's $1 million on the half, and then the $1 million.
Yeah, so the retirement exemption becomes the residual bit. So if all your discount, so you can sort of go backwards from that. I'm just doing it. $1 million, $1 million becomes $2 million, becomes $4 million. So you can actually get rid of a $4 million gain with that, using that whole retirement exemption. And then the 15-year rule over the top of that has some other, essentially the same thing. It's a disregarding of the gain, and there's an amount you can put in. So, but the mechanics are, 50% general, 50% active, retirement exemption, get rid of it all. So that, that's the ideal scenario. You've got to have a certain amount of shareholding. You've got to have done certain things. The one that, can trick people up sometimes is that more than 80% of the assets need to be active. So if you've got big
cash
big
in
cash
business,
balances that can cause us some challenges. You generally tend to bleed that out into super as part of the transaction, but that's matter.
And so, Tim, on that, just thinking through that, if you're trying to work out what the value of the assets of the company are you then valuing the goodwill of the client base? So you take 100,000 recurring revenue, you say that that's worth $300,000.
Yeah.
But if you had $300,000 in the bank account as well, a portion of that cash in the bank may not be considered active.
Yeah, so there's a sort of working capital component you can say is active, and it's always a lot. If there's a lot of excess retained earnings, that generally tells you. Now it's simple enough. You sort of just declare dividends and do other things to get it. But the whole point is you've got to understand where your exemptions are and plan to get those out. It's a sort of funny story. I had a client I worked with like 20 years ago, and in the middle of the transaction, I was sort of similar but different. Like he sold his house, so the house
was exempt.
6 million for the 6 million rule. Sorry, that's the other thing about those exemptions. You've got to be under 6 million, which we can always. But that went. The principal residence doesn't count in the 6 million rule, but the cash does, and so had to go and buy a house very rapidly. So that's good. And then, the second transaction is really where I have a corporate entity. And if you think in terms of the asset is owned in a trust or a discretionary trust, that's the same as an individual. So you'll get all three of those in there.
Yeah,
that's fine. The anomaly you get is in a company, you can get the active asset and you can get the retirement exemption, but you can't get the general. Now, as with everything in this world, it really boils down to the numbers. So if you can get $1 million in retirement exemption and $1 million active asset, so that's a $3 million asset you could do in there and get away with. And there's some nuances around how do you get that retirement exemption out of the company, but that's sort of technical detail thing.
So you're selling in that scenario B, Tim, you're selling 100% of the goodwill, i.e. the client base from your company typically across to a different company. And so the sale proceeds kind of firstly go into the company bank account.
Yes, so that's right. So that's the issue, is that money goes in there, and then how do I get that money out?
How do you get the money out? Yes.
But you've got to remember, and this is where the franking credit issue becomes quite interesting, because that's a piece of untaxed income, and so you can. But there will be some franking credits, and the little known fact that people don't really understand is that there is an option in a company, which is a way quirky left field stuff, where you can distribute a tax-free gain to an individual tax-free via a liquidator. There's no other way to do it. So you have to put the company into an voluntary liquidation, and then that's an option. But look, we generally don't get to that because of all these other.
Correct. And you don't need to get there. A, if you ever thought you needed to, people are going to call you now, Tim. But B, the thing is, we should be applying, as you're saying, the most simplest rules anyway. And if all the simple rules get you to pay zero tax, great. If all the simple rules get you to pay a small amount of tax, that might be better off than overcomplicating it with a liquidator and the work, because there's a cost to those things. So we're trying to do the right structures, of course, Tim, but keep it simple where possible. And so both of those flows can result in you paying no tax, but the company doesn't get the general discount, which we know that's just in whatever asset that it owns, it doesn't get the general discount overall.
Yeah, there's two things to remember too. One is, you can get a really good set. I mean, I've got a guy I use on capital gains tax who that advice costs you say $7,000 to $9,000. It's the highest return on investment piece of advice you'll ever get. Because I had one, like I'm working on one at the moment. The difference between getting the exemptions and not getting exemptions is $900,000. So to pay $7,000 to protect you from that is great. The other thing is too, sometimes what you can do is reset your cost base earlier if you think you're going to have a downstream problem. So you might say, so for example, you might say, I'm just particularly around the $6 million rule. That's a key one. If I'm going to breach that, let's transact under that threshold, run it through, reset the cost base, and then in the future, I'm only really going to deal with the gain above that, which most of the time is not material. And
so what do we have to think about? Like, so if someone's approaching these numbers, what is resetting the cost base actually? How do we do that?
Well, you engineer a transaction before you do a transaction. Essentially, what you're doing. So, because what you're saying, so I wait another 3 years, my net asset's going to be over 6 million. So it comes back to that 0 versus 900 example. If I just, for example, sell those shares to a new trust or to a company or something like that. So, for example, you could sell the shareholding to a company, trigger the capital gain. It sits in the company with the cost base, and then really you're only ever going to pay above that cost base, the gain above that cost base, and that sitting in a company 25 cents in the dollar on that bit above, plus a frank credit, happy days, we're off and running.
And then you're waiting for the next liquidity event, which might happen in 1, 2, 3 years or beyond. But you can't, once you're over 6 mil, it's very hard to get under 6 mil.
No, that's why, plug my wares again. Having a really good understanding of where your valuation's at any one point in time is pretty important. And bear in mind that, for CGT transactions, the nature of the valuation you use is very important. You have to tick certain boxes. So people ring and say, can you do this for a CGT? I said, absolutely, we can do that for a CGT purpose, but it has to be, it has to have all these features, APS 225. We can't do so we do have an indicative process in our valuation, is sort of more cost effective, but that won't necessarily get you through a CGT issue. But you might, 5 years out, say, let's have a look at that now with an indicative, and then in a year out, so we'll now need to rev that up to X to get there. So, but again, at the end of the day, if you understand where your valuation's at, you can plan and, sometimes, and look, you plan and know the transaction. The other thing that people forget is if you get an offer and you don't understand where you're at tax-wise, you're at a huge disadvantage. And one of the things I've seen happen when we've tried to sell a business, we get all the way through and someone says, hey, hang on, I haven't done my tax work. That's a disaster because your negotiating position just evaporated.
Yeah.
And so...
Yeah, and you can actually accept, obviously there's scenarios whereby you could accept $10,000 less in sale price, but yet end up with more on an after-tax basis through that process. We had a client that sold 41, they owned 41% of the entity, and that has a different qualification to below 40%, if I'm correct, Tim, and therefore...
I thought it was 20, because it's 20 for a significant share, but look, run with the numbers.
Oh, yeah, maybe I'm getting the numbers, but the numbers were that if they ended up owning either 1% more or 1% less of the company and then sold it, they would have actually ended up with more on an after-tax basis in order to use the rules. But so obviously tax advice along the way to be planning for this is really important. And then if you're ever in sale negotiations, indeed. Let's change it up a little bit, Tim. We kind of hinted at this around the debt side of structures. This is something you and I have tagged each other on LinkedIn and had a chat about this in the past. What's the people out there may trade through a discretionary trust, obviously with a corporate beneficiary in the car context, but what's the issue with having debt and a discretionary trust?
Well, I think you sort of went through it before. If you realise two things, a financial planning practice, even net of the interest cost, is generally pretty profitable. So that profit is made in that discretionary trust, and it has to be distributed to an end taxpayer. Now, it's unlikely that you're not, that you're going to end up with a very low rate taxpayer to be able to distribute that to all the time. And so therefore, essentially what it means is that you're going to pay the top marginal rate on the principal reductions on the loan versus in the company 25 cents in the dollar. Now, over the journey of a debt reduction in 10 years, it's a massive number. It's just a massive number. And again, you're paying tax you can never recover. One of the quirky things that's out there too now that people have sort of missed is that, because I've got 3 or 4 kids, and what we've found with that, even though, is if they go to university, which a lot of them do, they end up with large HECS debts, and so the ability to distribute and not generate tax bills is actually less and less now. So that's just a quirky thing that's happened. But again, paying, taxing principal reduction at 25 cents in the dollar versus 9 cents in the dollar, it
makes a big difference. We've done
huge difference over the journey. Okay, go.
Tim, is moving from a discretionary trust to a company, is that an example of resetting the cost base as well?
Well, essentially, yeah. So you can, and so often sort of explain slightly differently. Like in a normal small business, people come in and say, I'm just starting a small business. And what we tell them is, we just trade as a sole trader at the moment because, the cost of the company, the setup, all that sort of stuff. And then when we get it to a certain size where the taxable income justifies, moving to a company, we move it then. And then generally speaking, that transaction can run through the small business and end up in that company pretty much tax-free. So it's the same thing. There's a point in time where you can move it and, get it to work much, much better. So there are junctions where it is, you just don't want it to get too big.
It's something for us to think about just in terms of how we structure ourselves. And if you're in a trust with some debt at the moment, then you can chat to Tim to navigate what the advantages and disadvantages might be.
Look, if there's debt in that trust, one of the things, it comes back to what do I give up versus what do I get? Because you sort of work out, if I keep doing it this way, I'm going to pay this, or the capital gains to move its Y. What's your payback period? And often we find that, like, if I trigger, say, 20 grand's worth of capital gains tax, I'm going to get that money back in 2 or 3 years and simplify my structure. We did one with a guy recently where with the tax advice, was very, very complicated. But, once he came out of that, he could have a very simple structure and a very simple, this is how the world works, sort of.
And the other thing, Tim, I think through that process is the difference. Everyone's probably thinking about, why am I worried about this in other debts that I might have versus on residential property and other things like that? Predominantly, it's because the industry will put business loans on amortization. So we have to repay the debt over 7 years, 10 years, or 15 years, whichever one. But that's quite a large amount of amortization versus if you think about, I bought a factory in a discretionary trust, I might be able to have 15 years interest only and then renegotiate the interest only again. So I'm not concerned necessarily about the principal repayments. Whereas in business loans and financial planning, I haven't seen longer than a 5-year interest only period. If someone knows of one, let me know.
No, it's very difficult I'm just doing a calculation. Point two, like in a $70,000 principal reduction on $1 million loan over 7 years, you're saving $14,000 worth of tax. It's a significant number. Over the journey, that's $100,000, and so it just makes. And you're right. The behaviour of the banks, just for the record, is a name. They have no concept of what a commercial outcome is, but let's just push their idiocy aside. Logically, a Tim Lane would go and say, I want to pay all that money off my non-deductible debt, and I want to maximise the deduct. You've got the same security, you've ended up in the same position. Why have you got a problem with it? That argument's been lost on those. You can't do it. So to your point, you will not get a significant loan out of anybody, although I will be honest, to be nice to Macquarie Bank. In certain circumstances, they're more flexible in this area. They'll let you sit at, I think, a 3.5 times EBIT and carry interest only for. But you have to work on the assumption that most of the people doing this are small and getting bigger, and so they will have large principal reductions to deal with, and the numbers on the tax position are just,
they just get obviously bigger and bigger as a result.
Crazy. You just wouldn't do it.
Absolutely. So Tim, the other thing in terms of structuring that we see from time to time is a portfolio of companies all doing similar things next to one another. So and this is coming back from the older things of having a service trust, whether you're a medico or a lawyer, you've got a service trust or a service entity, then you've got your trading entity, then you might have your intellectual property entity, then you might have your AFSL entity. So we ended up at different points in times, we've seen one financial planning business with maybe 3 or 4 different entities. If you're starting from scratch, is that something?
I always believe we've got to have simplicity. I will concede the following: like often we would like to see the AFSL in a separate company because of the risk management and how that works. So if I'm just a car of someone big like Genesis or whoever I were with Fortnum, happy, just a company, discretionary trust, license comes from Fortnum to the company, simple, happy days, easy to manage. If I then get my own license, you would tend to put that in a separate company because it just keeps the compliance and the stuff sort of separated. Anything more than that, I mean, the service trust is an interesting idea, but service trusts predominantly were set up for medicos who have the specific rules around how much income can go into those. I just don't think what you really want to be arguing as a financial planner is a normal commercial enterprise paying normal commercial salaries. So my profit isn't compromised in any way, and it's all trying to land in a 25-cent tax bracket, which is the company rate. So you can have them. I just think complex structures lead to unintended consequences that you don't think about. And at the end of the day, you can, with a trust as the shareholder, you can sort of push enough around anyway to the right place. So
yeah, correct. And this whole thing of, most of us, you may have started this structure and had this simplicity, and we're going to potentially add new shareholders in the future. And so when you have all these entities, then you try to add new shareholders. When you ran it all, potentially you were like, I can manage all of this and it's making sense for my personal situation. But the moment you bring a second shareholder in, you have to just change the context of all these things that you're doing, because now you've got to explain it to 2 shareholders and
I think the other thing
families.
The other thing is you lose line of sight on your profitability is the other thing that people forget. Like, we did some of the, you ring up and say, what's your profit? Oh, well, we made 100 here and we made 100 in the service center. So how much of that is crossover? You got to work it out, and your valuation becomes more complex, more expensive. So simplicity is the key, and the value of those additional entities is questionable because you've got compliance costs, asset costs, all these other costs of running them. What are they actually providing? Now, some people argue we've got some risk protection and all this sort of stuff. I think some of those risks are overrated versus the cost of what you actually pay.
Yeah, if I can tell you, if you could save me $4,000 a year on an additional accounting tax return, you could spend that on insurance to take insurance policies out against those risks. Yeah. And the policy, predominantly the stories that I've always heard was always like employment related risks, like employee risks, which can be insured for in a variety of different ways. I don't think anything could happen that could impact that. So there's a growing trend, I think, Tim, I agree, of trying to get these structures simpler as you're operating them, because the operation gets even more complicated as you grow. If you've got 3 companies and add 2 shareholders, we were talking before about the amount of issuing of new shares or share buybacks across multiple entities in order to do it without a true demonstrable benefit of that.
And you do lose sight, like the thing I've learned, I've got a big client who's not a financial planner, but his story is valid. Like, he's got some operating assets in one and the rest in another, and they're for good reasons for that. But we spend a lot of time trying to work out where the intercompany transfers go and how they're affecting the outcome of the cash flow. So the profit lines are easy to manage, but I've just made this much in profit, but I haven't got cash. Well, that's, where did that go? It went there, and because one entity's reducing principal and one entity's not, and so again you lose line of sight. And you got to remember, if I'm going to buy your business, right, I want a simple, low risk transaction. So if I pay this number, what do I get? And I'm going to go, oh, okay, I've just got to buy those shares and I get everything in that box. That's it, what I get. I don't have to, whereas I've got to buy that box, I've got to buy a bit of that box, there's some stuff in that box. That leads to higher DD costs, higher risk. Buyers tend to behave differently because they see complexity.
Mm.
And look, let's be brutally honest, Dean. Our post-Royal Commission, financial planning practices are very simple business models.
And they should be, yes. That you're absolutely right.
Yeah, there's no need to be complex. There's, just keep it simple, and whenever you do, you get a good outcome.
Yep, absolutely. A little random thing on our list. I'm not sure how much comment we need to do, but just obviously payroll tax as we grow our financial planning businesses catches us out in different states. What is it in Tassie?
It's just that's a shithouse tax in any state.
No, better. We're not all moving to Tasmania then.
No. It's like it hits a threshold. I think ours is 1.2 in salaries. I can't remember.
Either 1.2 or 1.4 in Tassie, I think.
But
it's a bit less in New South Wales. It's about $1.05 million, I think.
It's just a function of it's a cost that you bear when you get to a certain size, and that's why understanding profitability and the stepwise nature of cost structures in financial planning. You just got to be careful because you do bump into that. And you go, oh, wasn't expecting it. I mean, the classic one is sort of a similar vein is people don't understand that when you move from what happens when you move from a cash basis for GST to an accruals basis. Basically, you end up losing cash flow equal to 10% of your revenue in one hit. And so they're all sort of trigger points at these growth phases. But at the end of the day, you can only plan for them. Payroll tax is just a diabolical tax because it provides no value. There's nothing.
And there's my mum works in payroll as well, and we were chatting about the data matching of the ATO and all the government agencies. Like, there is no way of doing anything creative that would ever result in the departments not knowing your wage books. And so it's just one of those taxes that at the moment you couldn't hide it.
But you're right, the data matching that we're seeing, particularly in the accounting practice now, is just amazing. And and the ATO is far more aggressive than they've ever been in my life. So there's no point. You just got to plan for it. But it goes to the point that at certain sizes, you really got to be careful about your pricing, because if you're going to bring another cost on, like a new planner or grow, what is the cost versus the benefit? And there may be some who say, look, we're going to make more profit just sitting under the radar here, just below the threshold, because it's a real fall off a cliff tax. It goes from zero to. It's the same thing if you go get your CGT wrong. It goes from zero to a large number. There's no in between bit. So you've got to be very conscious of that.
Absolutely. And Tim, the last thing just to think about as well in terms of getting money out. So we've had good years. We might have repaid some debt against the company, and we sometimes find ourselves in this situation where we've got all this retained earnings. If I was to look at my balance sheet, it says that I've got $500,000 worth of retained earnings, but I don't have that money because the money went to repay the debt. I don't want to retire yet. I don't want to sell my business. Does it sit there forever, or can I get retained earnings out without cash?
Well, you can get it out, but you essentially just generate a tax bill for no benefit. So and again, sort of a bit of planning around it is that sometimes you can use bucket companies. You're holding through the trust to the bucket company. The problem you get with that is that only works if the cash follows, and if the cash doesn't follow. So inevitably what you'll find is, and you're going to ask me what's the value of a franking credit, and I'm going to tell you I don't know, because you end up with these people, I get this question, like I've had this debt, I've paid it off, I've got all these retained earnings, and what's that worth? And the simple answer is it's not worth anything. Because it's too hard to value. It has a future value. If you can upstream it to somewhere, which is what we would say, but in multi-partner practices now, it's just so hard to manage that issue. You sort of have to accept that the value of the acquisition and the debt where it got you to justified not really getting those franking credits.
Yes. Yeah. And I would, if I was valuing my company on the back of the envelope for the shareholders, I don't think I would include retained earnings as a thing, or the value of franking credits as a thing, because it's who knows who's going to get it and when, given all the other things that's going on at the company.
Well, you got to remember, the value of franking credit is in the end shareholders. They're the only person that can get value for that. So it's just a quirk in the system that you can't fix.
And I think it's not just small. There's a large businesses that probably have this exact same scenario. They would be sitting on millions of dollars of franking credits, and I'm sure there's smart people trying to work out how to get ownership of those entities in order to pay out the franking.
Well, you've got to remember too, even if you haven't had a debt reduction, like I've got clients who've retired, sold their business, all that sort of stuff, they have mountains of franking credits, and the nature of the mathematics in the tax system means that, you know, unless you want to pay tax to get tax, you know, there's a limit on what you can really get out. And that's why, you know, passing a company with franking credits in it through your estate at least gives the next generation an opportunity to do something. But, you know, it's limited.
Yeah. And then it's that complexity of going, do you want to do that?
I mean, occasionally you get a circumstance where you can, you know, I won't give you the details, but I had to change a relationship, pushed out a big frank distribution through a company to a particular trust and got a franking credit back. But if that person hadn't come along, we had no hope. So you got to have it tweak your eye to seeing those, but you know, they're not always there anyway.
No, they're like the unicorn. They're the unicorns. They don't always exist. So Tim, anything else that you haven't yet told us? Otherwise, it's over to the plug for your Spotify.
Yeah. No, well, look, I mean, all we would really say to people is, you know, we run a sort of triage process. If you've got a question, you're better off to ask it up front. We'll say, look, do this, do that, or go there, go here. Don't try and do these things in arrears. Any sort of succession related thing, be it a valuation, a sale, or whatever, planning is so important. I mean, I got one in, you know, a Windjet in the market at the moment where we did something. I told him to do something 2 years ago. Hey, he didn't do it. And what do you think we're working on fixing it right now?
The thing you told him 2 years ago. So
yeah. So you just got to.
People can give you a call, chat through.
Yeah,
this is what's going on.
The owner or even Courtney, like there's a triage process. And the other thing is, if you want good information, Fiona will tell you you can download our guide to valuation and succession, which is a very useful document. So that's worth a read. I wish I could say I did that, but it's all Fiona.
We'll put it on the link underneath though, Tim.
Yeah.
So
I did the music, Fiona did the document. But look, and as I said, reach out to us if you've got something. Every conversation isn't a piece of work. It's about sort of helping and educating. From my perspective, it's much easier to help you in front than later. If something goes wrong, that's a harder thing to fix anyway. So I'd much prefer to talk to you about it up front.
Yep, very good. And Tim, the music career? Tell us about your Spotify.
So it's sort of my passion is to write and record music and play. There's sort of 10 songs in there, all original, and you know, you describe them as sort of 80s influenced rock. But you know, follow me, play a few tunes. I'd really appreciate it because it gets me just that little bit further down the track.
Good man. Well, it's on the screen. We'll put a QR code for the people that are watching afterwards, and all the details in the notes on the website as well for those that want to follow Tim and give him a little listen as well. And obviously, you're already listening to UnCommonCents as well, so that's great.
And just any problem, reach out because we'll help.
Brilliant. Thanks, Tim. That's been a great chat. Thanks everyone for listening. If you're listening live, put a comment on LinkedIn so other people know to listen to Tim's magic about getting structured correctly. And if you're watching afterwards, reach out with any questions or comments, and we'll see you next time. Thanks everyone. Bye-bye.
Thank you.
Thanks, Tim.
Bye.